Welcome to lecture 2. In lecture 2, we have 10 topics which we are going to learn, and it's quite interesting starting from hard fork and down to the types of cryptocurrency supply. So, in this lecture, you're going to learn the differences between hard fork, testnet, and mainnet. You're going to learn about smart contracts and apps, stable coins and tokens, tokenomics, halving, burning mechanism, crypto mining and types of crypto mining, wallet and exchanges, private keys and types of private keys, how to create a wallet and an exchange account, and the types of cryptocurrency supply. This lecture is quite very interesting and we are going to learn a lot. So let's dive right in. Beginning from lecture 1, 2.1 actually, lecture 2.1, the first topic here. A hard fork occurs when the software of different miners become misaligned, and it is up to the miners to decide which blockchain they can continue using. If there isn't a unanimous decision, then this can result in the creation of two versions of the blockchain. There can be period of increased price volatility around this kind of event. And when soft fork like Bitcoin Cash, Ethereum Classic happens, this always lead to surge in prices, and it could also lead to dump in prices depending on what happens or what is the future or the potentials or the prospect of each of these blockchain. So the price tends to uh, go volatile during this period, and a soft fork leads to the creation of a new blockchain, and it's not very nice, but sometimes it's very necessary for the improvement of that chain. Maybe sometimes due to hacks, sometimes due to disagreement, sometimes due to whatever reason it might be, it results in the creation of new blockchain. Steam is an example of, sorry, Hive is an example of a fork that came out from Steam blockchain. Blot is another example of a fork that came out from Steam blockchain. So when talking about soft fork, you also hear stuff like hard fork. You also hear stuff like soft fork. A soft fork is a forward compatible change to the rules. It does not create a new blockchain. So that's the key difference you need to note, that soft fork does not create a new blockchain, but hard fork do create new blockchains. Soft fork is more like an upgrade of the network which we are currently using, and hard fork is a split. It's a split, and there will be a new chain, more like the Protestants leaving the Catholic Church, something like that, to create their own ecosystem. Hard fork happens that way, but soft fork is more like the Catholic saying, okay, we no longer want to sit this way during mass, we want to sit this way during mass. So an improvement, and that leads to a lot of people in the network agree, and that leads to improvement of how they worship a Catholic Church. So I was just making a typical example based on the Christian religion here. uh, a testnet, let's move on to that. A testnet is a test network designed to experience the different improvements in blockchain without causing harm to the usual network. I don't know if that is very clear, but it's designed to experience, like if you're a developer, you want to deploy your apps, which I talked about in lecture 1, uh, you have to go through a test net, like test your smart contract, your app, or whatever you want to do on the mainnet or the test net first, to see the experience, to test if it will run on the blockchain, to test if the blockchain has a capacity to handle what you're building before you deploy on the mainnet. And mainnet is simply a term used to describe when blockchain protocol is fully developed and deployed. When your smart contract you're building, the app you're building is fully developed and ready to deploy, it's deployed on the main net. So this infographic here shows you the main differences between mainnet and testnet. So a mainnet has a functional blockchain, while mainnet has a testing environment. Real transactions are stored on actual blockchain, but these on testnet, the transactions are not real. They are just test transactions to see how things are happening. Uh, Mainnet possesses real value, and testnet no monetary value at all. Paid using native coin. Testnet is free. Maintenance of mainnet or transaction frequency is high compared to that of testnet. Mining and economic incentives are real on mainnet but are not real on testnet. So going over, you would see also the differences between hard fork, soft fork, hard fork and soft fork, which is on this infographic that I added here. Let me move over to the next topic so that we can save time. smart contracts and dApps. This is the second topic in lecture 2. From what we have here, a smart contract is a self-executing contract with terms of agreement known as transaction protocols, and it can auto-execute itself based on the terms of the contract. So a smart contract is more like an autonomous contract, a decentralized contract that can execute itself without any central authority having to go and pass the order and say this must happen. Smart contracts are just deployed whenever a certain conditions or criteria or parameters are being met. For example, I say open my door whenever somebody imputes the code 121234 and says hello, I am here to break down stuff like that. So if someone says that at my door, a smart contract will deploy and opens the door, send a timestamp to the blockchain showing that this door was opened at this time for this person and whatever reason. And when the person opens the door, there will be maybe another smart contract inside the house, and anytime you want to access anything inside the house, you need to say some code, you need to give it some input. Actually give it some input so that it will give you the respected output that is based on agreements on the smart contract. For example, if I also have a smart contract between my student and myself, which I create content and I store on the chain, and I say, okay, if you pay a fee of $100 or $200, $300, $500, you'll be able to access this course, and I don't need to be there to teach you. I deploy the smart contract and put it on chain. So when you make that payment, you're going to make the payments, input the conditions. Maybe I have a test that I check whether you have done your assignment or stuff like that. Check in, you pass all the checks on the checklist, and the smart contract verifies that you are a real student and you have done this, done that, and opens the course for you to go ahead with your studies. So decentralized applications, or dApp, that's a short form for decentralized application, is an application that can operate autonomously. It makes use of smart contracts on blockchain as its backend. I think that's pretty straightforward. And the characteristics of dApps include data integrity, censorship resistance, trustless computation, it has no downtime, and privacy are all characteristics of these dApps. Due to the fact that it is anonymous, anonymity or unanimity gives room for privacy. But privacy is not actually private when it comes to blockchain, because if I actually track that this unknown identity or this unknown wallet belongs to a certain group or a certain person, I can actually easily track that down and see the transaction open. So to make that truly privacy, you don't need to have to let a lot of people know, or people who are not in business with you, know that this is your public keys or wallet address, as the case may be. So if you go through this infographic, you are going to see some other details about smart contracts, and this also compares this other infographic over here compares the smart contracts, or sorry, this compares a dApp and a traditional app. dApp and the traditional app, compares it based on the characteristics. This is the traditional app first here. Characteristics based on control, based on design, maintenance, failure, stability, vulnerability, unethical operation, and scalability. All these comparisons are what helps us to determine the differences between a traditional application like Facebook, Snapchat, TikTok, and all those platforms compared to a dApp. A dApp is quite different from all these guys. Let's move on to the next topic. The next topic here is stable coins. As the name implies, stable coins. But let's dive right inside. Stable coins are cryptocurrencies with pegged value to a reference asset or cryptocurrency. Note that I say the reference asset or currency. Stable coins are cryptocurrencies pegged with a value to a reference asset or currency. Pegged to a reference asset or currency. I need to emphasize that, because when you dive right into the different types of stablecoin, you're going to see the reason why I had to say asset or currency. So based on the types of cryptocurrency that we have the fiat-backed cryptocurrency, we have the commodity-backed, we have the crypto-backed, we have the non-collateralized, and I'm pretty sure with innovations many more will come. These are the ones I was able to figure out. And the fiat-backed stable coins are those that are backed by a 1-to-1 ratio with a fiat currency. An example of that is the USD Theta, USDT, USDC, that's USD coin, True USD, that's TUSD, and all these coins that are backed by the United States dollar. The next one here is a crypto backed token. Example is MakerDAO, which is backed by Ethereum assets, Bitcoin and Ethereum, and there are other cryptocurrencies that are stable, but it is backed by the price of Bitcoin and Ethereum or any other cryptocurrency that it backs. And the next one here is the commodity backed. Commodity backed stablecoins are those that are backed by any commodity that is fungible, that is either interchangeable when it is traded on the market. Example, I've never seen this type of stablecoin before, but I think a pretty example would be being backed by stuff like paper, commodities, normal commodities that are fungible that can be changed in the market. So there are stablecoins that are backed by this kind of commodities and the volume of these commodities going on in the market. So there are also other stable coins which are actually backed by nothing, completely backed by nothing. So it's non-collateralized. That's why it's backed by nothing. Non-collateralized stable coins are the stable coins that are not backed by any asset, but they use algorithm to adjust the supply and demand of the stable coin in order to keep the value stable. That is quite straight to the point. So you might want to go to the internet, because research is very important for my students, and find out examples of all these different types of stable coins. You might want to buy some. You might just want to check it out and see how they really are and how they operate. Check out which chains they are deployed on. Do some of them have their own chain, or they just exist as token on other chains? So find out more on this and you will be happy with what you learn. Now let's move over to the next topic, which is coins and tokens. Coins and tokens. This topic is pretty interesting. Coins and tokens are both cryptocurrencies or crypto assets. Crypto assets. You need to take note of that. Coins and tokens are both cryptocurrencies or crypto assets. So I'm going to open up CoinMarketCap now so that we can actually view how the different example of coins and tokens on this coin index platform or crypto index platform. So let's have this and we will go right in. So like I said, coins and tokens are cryptocurrencies or crypto assets, are both cryptocurrencies or crypto assets, because some people might choose to call it crypto assets, some might choose to call it currencies. So that's just this thing you're seeing here, assets or currencies. So coins are cryptocurrencies with its independent blockchain and algorithm. Coins have its own blockchain, and the blockchain always has an explorer where you can explore transactions, and they will have miners, validators, or whatever the chain might want to call it, people that validate transaction. And they also have here operating algorithm, can be proof of work, proof of stake, decentralized proof of stake, proof of whatever they are running on. And also tokens, on the other hand, do not have its own blockchain, but depends on the blockchain of another coin to be created through a smart contract protocol. So tokens do not have their blockchain, they depend on other blockchain to exist. So their explorer, their hashing rate, everything that happens on a token is dependent on the blockchain, on another blockchain. And if that blockchain fails for any reason, the tokens fail with the chain. But blockchain is trustless anyway, so the chances of failure are slim based on the decentralized technology that is being used to create blockchains. And examples of coins include Bitcoin, the seniorest coin, Ethereum, Telos, Reef, Tron, Blood, Hive, Steam, and many more. Examples of token at this point, not what I said, is Sweat, which is deployed on Near protocol. Near protocol is a coin itself. It has its own chain, it has its own algorithm, it has its explorer. And Sweat, which is quite very popular right now, is deployed on Near protocol. So coins can become tokens on other chains through smart contract gateways and blockchain interoperability. And tokens can also become coins through mainnet launch. Like I said, sweat is a coin, sorry, a token at this point. They could decide to become a coin in future by deploying their mainnet or launching their mainnet. So if Sweat decides to launch their mainnet, they will become a Sweat coin, no longer Sweat token. So both coins and tokens can exist on more than one blockchain through smart contracts. Both all these coins and tokens can exist on more than one blockchain through smart contracts. And whether you're a coin or token, that's what it means. You can be on any chain. And coins like Bitcoin, Ethereum, Telos, all these guys, they are available on other chains. Telos is available on Binance Smart Chain, Ethereum's blockchain, and many others. Ethereum Bitcoin is available on Ethereum, Bitcoin, Ethereum blockchain, Telos blockchain, Matis, Polygon, blah blah blah. All these chains that has infrastructure for tokens and smart contracts to be deployed makes it easy for coins to become tokens on their own chain. So that's it for coins and tokens. Without wasting time, I implore on all my students to do more research on this topic because there's quite a lot to discuss and a lot to learn. So let's move over to topic 2.5, which talks about tokenomics, halving, burning, and the burning mechanism in crypto. So tokenomics, halving, and burning. In simple definition, tokenomics is a term that is used to describe the token economics. Tokenomics is the word is coined from token economics. Token economics, yeah, or coin economics. Let's keep going. You will see things quite easy for us to learn. Token economics. Sometimes it's also referred to as coin economics if it is a coin. Remember, we just talked about coins and tokens. And it is used to describe the characteristics of a cryptocurrency to determine its economic value. It is used to describe the characteristic of a cryptocurrency to determine its economic value. Tokenomics gives the supply information of a cryptocurrency in a peer-to-peer network, allowing users to know their maximum supply, their total supply, and their circulating supply. So let me break down a little bit of tokenomics. In case this is very new to you, tokenomics is what helps you see what the team plans in terms of their supply information, helps you to know their total supply and what is circulating, helps you know about their inflation plan, helps you know about inflation control plan, also helps you know about user acquisition plan, helps you know about who helps you know who is holding the most or the less of your cryptocurrency that you're holding. And if you know that if most of the tokens are being owned by a large group of people, tokenomics helps you to see that, oh, investors are holding over 60 to 70% of my token. Is that not centralization or centralized decentralization? It makes you skeptical, makes you analyze the project again before you make your investment decision and holding and you hold tokens that the high investors or big bag investors can just dump on you at any time. So tokenomics helps you see this picture in a better way. So this halving, which you see here, halving and burning mechanism, are all inflation control mechanisms. Halving and burning mechanisms are all inflation control mechanisms that helps users to see how inflation can be controlled on their chain. Users can either vote for this to happen, or validators or witnesses can also vote for this to happen. So halving is a term that applies for the supply of Bitcoin and other cryptocurrencies that adopt this protocol. There are other cryptocurrencies aside Bitcoin that adopt this protocol. So halving is a term that applies to the supply of Bitcoin. So like in this infographic which I have included here, it shows that when Bitcoin mining launched in 2009, miners were getting 50 Bitcoin for every reward, for every transaction, and that they confirm. So it kept on going on and on. After every 210 blocks for BTC, after every 210 blocks is mined, or roughly every 4 years, because before 210 blocks is being mined on BTC, it takes about 4 years. The block reward given to Bitcoin miners for the processing the transaction is cut into half, and this event is referred to as halving because it cuts, as the term implies, it cuts the reward into half. So you can see this from 2009, 50, 2012, 4 years later, 25, 2016, 4 years later, 12.5, 2020, 4 years later, 6.25, 2024, 4 years later, is 3.125. So this will keep on breaking down and down and down and down till further notice. I also heard some rumors, according to news that I read on some crypto blogs, that Bitcoin halving has been brought forward. The date for Bitcoin halving has been brought forward because currently we are in 2022, and it is reported that the date for Bitcoin halving has been brought forward from 2024 to December 2023 due to some network conditions, and the miners know what they're doing and why this should happen. Now, anytime you invest in crypto, you hear stuff like, if you're not investing, to hold for at least 4 years, to not invest, and always invest any amount you can afford to lose. Now, this Bitcoin halving is a big reason why other people who tend to give you investment advice in cryptocurrencies will tell you to hold for at least 4 years if you intend to invest in crypto. That simply means after every Bitcoin halving, if you go through the price chart on CoinMarketCap, where you will see different coins and tokens, after every halving, the price of Bitcoin tends to double. This is a coin. This is Bitcoin. After every halving, the price of Bitcoin tends to double. So if you go through the chart, let's see the overview. This is just a rough chart all time. So like, let's look at this. In 2009, 2012, I think this was tracked from 2012. So 2012, after the first halving, the next one was in 2016. 2016, after 2016, this is around 2017. After 2016, the price of Bitcoin in 2016 and early 2017 was around $800 to $1,000, and after the halving, this is what booms happens to the market. A bull run, which Bitcoin hit an all-time high at the price of 19,800 to be precise, because I was a live witness of this, and it came down again, down to the bottom at 3.6, where people were saying the price of Bitcoin is gonna crash, it's never gonna rise up again. Try to push back, ranging in this period till the next halving. The next halving happened in 2020. The next halving happened here. If you can see what is on my screen, the date is what is hovering over here. The next halving in 2020, and after the next halving, boom, in 2021 we went crazy. To 63,000, we came all the way down, boom, to 30,000, and we went all the way back up again with the influence of Elon Musk. Back to in 2021, it was really exciting. I made a lot of money, actually. I made a lot of money from Bitcoin and cryptocurrencies in 2021. So okay, we hit another all-time high, and we came back down crashing. Boom, boom, boom. Yeah, we crashed like Elon Musk's rockets. And 2024, what are you to expect? Same pattern? Probably yes. Everybody's anticipating this, and with the FOMO that is going to pull into the market based on these things, you're going to see what is going to happen in 2024, 2025. Probably a bull market by that time. So this is actually a very good time for us to buy, because Bitcoin is quite cheap. 16,300. I'm saying cheap. It's not quite cheap, but I'm saying cheap based on the fact of what would happen later after the halving. After the halving, you may never see these prices again. So this is not a financial advice. Make sure you do your own research analysis. So okay, I'm done with that. We move over to crypto mining and types of crypto mining. Crypto mining is simply a process of creating new cryptocurrencies in order to increase the circulating supply of that cryptocurrency. It involves solving complicated math process to verify transactions in a peer-to-peer network. So, depending on the chain algorithm and the type of blockchain, the mining process differs, and the names of the miners also changes to nominators, witnesses, block producers, or more. There are also two main categories of mining, which is called the local mining or the cloud mining. And there are different types of mining for which falls under these two major categories of local and cloud mining, and that includes ASIC mining, which falls under local mining, GPU mining also under local mining, CPU local, mining pool local, solo mining could be either local or cloud, and cloud mining is cloud. Yes. So what when I say local, it means you have the mining device over here at your location to take care of the mining activities that are going to happen. And when I say cloud mining, it means you are paying or renting resources in a remote location that is not yours to conduct your mining process and synchronize the mining protocol on your computer to mine rewards and transactions for you. So that's just simply put. So whenever you mine, you get rewards, and these rewards increases the circulating supply of that cryptocurrency, like I said. So yeah, that's pretty straightforward. It's pretty straightforward and easy for all of us to understand crypto mining and types of crypto mining. So uh, there's really a lot in this. There's really a lot in this what I just explained in a few minutes, and I wish you are a research-minded student so that you can go on to do your research on this, because it's it's a lot, and it's something which I practice on Telos blockchain. Let's see that here is authority. I also practice this on two blockchains actually. I do cloud mining, by the way. So this is Telos, and this is my node on Telos blockchain. Oh, here's my node here. I'm number 15 on Telos, in partnership with my partner in US, Nick Lopez, and we are ranked at number uh, 15. Our company, our block producer name is called Kanda Weather, which we contribute the Kanda data weather to this blockchain, helping to build its utility. We are doing a lot with Kanda Weather, and we're one of the elected BPs located in Uyo, where I currently reside in Nigeria. And we have many other block producers scattered across the globe in US, Australia, Iran, South Africa, blah blah blah. We have a lot of them here. So what happens here, you can see we get rewards every day for mining. You get rewards every day for verifying transactions, and this rewards in turns increases the circulating supply of this cryptocurrency. So yeah, that's it for this topic. We move over to the next one. A wallet and exchanges. Quite interesting. A cryptocurrency wallet can be a physical device or service which stores a public or private key. Now, before I talk too much, I need to open a picture of a hardware wallet, and I'll tell you why I called it a device or service. Hardware wallet. Let's see this. Yeah, I have a hardware wallet in my home, and this is a typical example of a hardware wallet, the type that I have, Ledger Nano. This is quite cool, which I use to store some Bitcoin and some other blockchains, cryptocurrencies that are supported on Ledger Nano. So these are, it looks simple like a flash drive, and if someone gets hold of this and is able to handle my mnemonic phrase, this person can take out all my Bitcoins. So there are other types like this Trezor. There are many other types. I think this is a picture of hardware wallets, different types. Man, this technology is cool. So you don't need any internet service to access that wallet. You can access it offline at any point, and the value will be based on what the value is in the open market. So when I say the wallet can be a physical device or a service, when you talk about service, one of the most popular blockchain wallet is called Trust Wallet, blockchain.com, MetaMask, a token pocket. There are many of them that are provides these services for you to store your cryptocurrency on the online platform. This is a typical example of what I'm talking about. So you store this with your mnemonic phrase and whatever keys you have to store your cryptocurrency on their chain, and then you would be able to complete your transactions there. Examples of a wallet includes a hardware wallet or software wallet, Cryptocurrency exchange, let's move on to that. A cryptocurrency exchange is a business that allows other customers to trade cryptocurrencies or fiat currencies. So when we talk about particularly about cryptocurrencies, it can be centralized or decentralized. Examples of centralized exchanges include Binance, MEXC, KuCoin. These guys are the big guys in the game. There are many. Oh, the brain is so fucking many, man. Let me see. Coin market cap. There are many. If you come to coin market cap, you would see exchanges. We have about 524 centralized exchanges on coin market cap. Okay, not just centralized. So we have the ones that trade spot, where you can trade spot market, where you can trade the derivative market. We have the decentralized exchanges. Like I said, decentralized exchanges do not have the centralized authority like what Binance has or FTX. You know, some of these centralized exchanges, they brought in problem like FTX. We've recently brought in a problem when they went bankrupt and customer funds were at stakes. So Uniswap, DYDX, Corp Finance, all these guys are typical examples of decentralized exchanges that allows you to swap your cryptocurrency for another cryptocurrency directly from your wallet. You don't need to deposit through a centralized exchange to complete this process. So centralized exchanges are open to prawns, they are open to hacks, their security system might be breached, and the management team that you are entrusting your money with can go by heart, like what happened at FTX, where they were using customer funds to fund Alamelda investments to invest in some shit project. Not shit project actually. There's some very cool project like Solana, Nestcoin, and many more. And then expecting double of the returns, we were running Ponzi schemes with customer funds, which was not good at all. So that's simply straightforward for types of wallets and exchanges. They'll do more research. And to open an exchange account, I don't have my affiliate link. I wish I have that. You can go to MEXC. There are many other affiliate links you can use. There are many. All the exchanges, centralized exchanges in particular, they're looking for affiliates. So I think I'm currently an affiliate. The people are taking me seriously actually, because I have different exchange accounts, but the ones that are taking me quite seriously at this point is MEXC. So please, I am if you are my student, you have to sign up on MEXC with my affiliate link, because I used to do YouTube live every week, and we sponsor some tips to traders that are willing to be active with me. So I will discuss that much more later. So so that's it. To open a wallet account, to open a wallet account, to open a wallet, when you want to create an exchange account, you sign up using your phone number or your email. So when you come here, like this is a centralized exchange, you sign up using your phone number or your email. So you can just include my email here or use my phone number to sign up when signing up on a centralized exchange. Then if you want to use a decentralized exchange, the first thing you need is a wallet. So you need to sign up on a wallet, or let me see, MetaMask, because MetaMask has a Chrome extension, MetaMask wallet. So you can create a wallet. So there are two things that happen with a wallet. You can either create a wallet, or you import an old wallet if you already have. You cannot sign up for a wallet. You cannot input your email and password. If you do that, that is not a wallet. That is a centralized platform. So please, you will get your private keys, and from wallet they used to have password security for you to protect your password just in case uh, somebody is coming in to use this ecosystem. The person will not be able to make transactions without inputting your password. Like another security system aside your private keys, because the private keys automatically authorizes this service to spend your money or authorize some transaction if you are not using it as a watch wallet. So when you create this watch wallet, there are the services like for token pockets. You see services on the Explore market, and you'll be able to swap your cryptocurrencies. The Smart Wallet, I used to use Smart Wallet too, and you'll be able to swap your cryptocurrencies for another cryptocurrencies using your wallet directly. And over to the next topic, private keys. Private keys and types of private keys. All these topics which I am trying to squeeze into a short period of time is quite long. Like if you want to take each topic down one after another, it will take us 1 hour each. And that would mean if I'm doing 9 topics, which is here, I'll be spending 9 hours. And we don't want to have such a boring long lecture because there's so much to say when it comes to all the topics we're talking about here. That's why I'm talking about research. Spend some of your time, do this research, find out some of the things that I've not mentioned in my video, because I'm pretty sure there are a lot of things that I haven't mentioned yet, and they are up here in my head and still out there in the internet, and research would help you find out more. Interacting with me at the academy will also help you find out more. So okay, let's move on to this one and understand what it is. A private key is a cryptocurrency variable. Is that straightforward? Okay, private key is a cryptocurrency variable that allows users to encrypt or decrypt sensitive data, complete peer-to-peer transactions, and secure their wallets. Is that still straightforward? Okay. All right. A cryptocurrency, a private key is more like your password, a highly classified password that helps you protect, like this password. When we talk about stuff like, let me use the term password because that's what you're used to in web 2. When we say password, you create a password on a certain platform. The platform which you create that password on, for example Chaindustry, has details of your password at the back end, but you have to trust them. It's just a centralized platform. You have to trust them. If not, you're gonna sue their company for trying to steal your phone, some stuff like that. So what private keys, the service, the hardware, whatever, doesn't have access to this wallet, to these private keys. You are the only one who has access, and they cannot change it, they cannot take action with it, nothing at all. So your private key is a cryptocurrency variable that allows you to encrypt, like protect or decrypt and authorize sensitive data, which could be your money, your amount of money you have, and complete peer-to-peer transactions on your wallet. So there are different types of private keys, which I found out that we have the wallet import function, we have the mnemonic phrase, wallet import function, or the mnemonic phrase. Wallet import functions, I'll show you how it looks like on the web, and mnemonic phrases, how it looks like. When you open a wallet on MetaMask, Trust Wallet, all these services blockchain, even hardware wallets, you need mnemonic phrases. Let me show you a typical example of what that looks like here. So mnemonic phrases, mnemonic phrase, check out for images on mnemonic phrase. So they can give you a 12, 14, 16, 24 character, where you have to provide them in this sequence: number 1, 2, 3. If you provide number 1 and you jump to number 7, you're gonna get screwed. Honestly, you're gonna get screwed. So look at this. This is a typical example. If this is your mnemonic phrase, you have to give mushroom, warfare, main. You don't give and you give dilemma, blah blah. No, that's not you. You're gonna be knocked out of the wallet and you'll not be allowed to access. So that's for mnemonic phrase. Let's see the wallet import function. If you open a typical example, if you want to see what wallet import function, private keys, yeah, wallet import function, private keys. If you want to really see what it is, open a wallet on Steam, Hive, and all these chains. They have, you'll see where they ask you enter private key, and you enter something that looks similar to a public address. That's your wallet import function. That's a wallet import function. This is another example. This is your wallet import function. That's exactly how it looks like. For example, on blockchains like Hive, you see them giving you password like this in place of mnemonic phrase. Sometimes wallet import functions are more safer because mnemonic phrases, for sharp brains, they can cram it faster, and they can access your wallet. Yeah, some people are very good at cramming, but this one is gonna give people that are trying to breach your security by cramming a tough time actually. So let's also move on to the private keys and opposite of private keys. The opposite of private key is a public key. Public keys are more like, for example, if you have an account in a bank, the account number which is used to receive money is your public key. Public key is your public identity on the blockchain, where someone can use to send you money or receive money. Like if you create a Bitcoin wallet and you want to receive a transaction using a public key, you're going to provide your public key to someone who is going to send you money from wherever it is in the world, and you're going to receive that money. On some blockchains like Steam, Hive, public keys are replaced with usernames, where you see public keys being replaced with usernames like Empato365, Empato, Chaindustry Academy, and all this replaces the public keys, which are always in alphanumeric and looks like abracadabra and uneasy for people to cram. So it's easy on Graphene's blockchain for you to memorize your public key, which could be your username like Empato365, and tell, hey man, send me $500 to my Steam wallet using my wallet public key, which is Empato365, and I'm going to receive it. Once you do that, I'm going to receive $500 in my wallet, and I'll be able to do whatever I want to do with my $500. That's how cool it is. And of course, you have your private key, which could be your wallet import function or your money phrase to protect that money. If not, one guy on the internet is going to take it away from you. So how to create a wallet and an exchange, I think I already showed that already. It's pretty straightforward. If you are opening a wallet, note that you create a wallet and you sign up on a centralized exchange. You create a wallet, and when you create a wallet, you can use it to access the decentralized exchange or other wallet services or other services that need wallet to access. And please note, there are phishing websites out there that will be asking you to connect your wallet. Please always confirm, double check, ask somebody who is experienced before you lose money. I have a friend who lost some good money to scams that were looking like GMT. GMT is of course Stephen. So please be careful of this. When you connect your wallet, they could wipe out all your funds. It's really risky. So check out for phishing website. They will look really like the real website. So confirm, double check, go to the official community and everything, and double check that it is all correct. So you create a wallet. You either create or import a wallet to these services or your hardware device, and then you sign up on exchanges, centralized exchanges, as the case may be. So that's it. Pretty straightforward. This course is straight to the point, and we were able to explain this in just 42 minutes, which is interesting. Yeah, so that's it. I wish you can do more research on this topic on lecture 2. These are the topics that we have here. It is long. These are 10 lectures. It is long, and you need to do research as much as you can. So I think there is a topic which I didn't include a slide here, which talks about types of supply. I need to talk about that in the shortest time possible so that we don't make this video too long. So types of supply. Before, to make it easy, I go back to CoinMarketCap, which is one of the most resourceful websites in cryptocurrency that has been acquired by Binance, a centralized platform. And it's quite sad. What if something happens? Like FTX acquired Blockfolio, and today we lost Blockfolio because FTX is down. Quite sad too. Okay, so types of supply. Like I said initially in this video, we have maximum supply, total supply, and circulating supply. Maximum, total, circulating. So for blockchain like Bitcoin, they make use of maximum supply. Now maximum supply is directly proportional to the total supply. Don't get confused. Assuming total supply is provided, maximum supply is directly proportional to the total supply. And if the maximum supply is not provided, total supply is directly proportional, is inversely proportional to the circulating supply. So I don't want that to be quite confusing. When you come to CoinMarketCap, you will just hover around the circulating supply, tap on this, you see details that helps you read more about this. The amount of coins that are circulating in the market and are in public hands, like me and you, on exchanges, blah blah blah, in our wallet, it is analogous to the flowing shares in the stock market or in the crypto market in this case. So maximum supply, the maximum supply is the amount of coins that will ever exist. Note that ever exist in the lifetime of the cryptocurrency. So for Bitcoin, we only have ever 21 million Bitcoin to exist in the lifetime of Bitcoin, and it is analogous to the fully diluted shares in the crypto market. Let's use crypto non-stop. If this data has not been submitted by the project or verified by the CMC team, coin market cap of course, max supply shows bam bam, have not verified it. And total supply is the amount of coin that has been already created minus any coins that has been burned, like this. Yes, that has been burned. It is analogous to the outstanding shares in the stock market. If this data, okay, if it is not submitted, the same thing. So it is the amount of coin that has already been created minus the ones that have been burned. You grab. So this is like the total supply in the market. And don't get confused, please. Do more research on types of supply. And if you come to coins like Ethereum, you'll find out that Ethereum doesn't have a max supply. It doesn't be provided or verified. So Ethereum has a total supply of 122 million Ethereum, and the supply is circulating. Oh, their total supply is directly proportional to the. So it keeps on increasing based on mining and burning, and it keeps on increasing based on mining, it keeps on reducing based on burning. So that's Ethereum for you. They have a very different economics compared to Bitcoin, and there are many other coins. If you go through their supply information, and you'll be able to learn more about this. So that's it, and I'm happy I was able to walk you through these 10 topics in lecture 2, and I'll see you over in lecture 3. Bye for now.